Hi all, this is Akshara Menon welcoming to today's webinar. Markets have been nothing but not predictable. In this times like these, investors are looking out for clarity, discipline, strategies that can navigate volatility without losing the sight of long-term wealth creation. That brings us perfectly to today's discussion, finding clarity in volatile markets, a large cap led ASK core strategy. To help us to decode this theme, we have joined by Mr. Anunaya Kumar, President, Sales and Distribution at ASK Investment Managers. Anunaya leads the firm's sales and distribution functions that brings with him over 25 years of experience across financial services, asset management, and banking. He has played a pivotal role in building high performance teams, scaling distribution platforms, forging strategic partnerships that drives sustainable growth. At ASK, his focus is on aligning people, processes, and technology to ensure that the firm remains strongly positioned in an evolving market landscape. Prior joining to ASK Investment Managers, Mr. Anunaya was held as in senior leadership at roles like 361 Asset, Invesco Mutual Fund, DSP BlackRock, Royal Bank of Scotland, Citibank, IDBI Bank, and Tata Finance, contributing a meaningfully to business transformation to growth and across organizations. Today, Ananya will share his perspective on how investors and advisors can stay focused and manage expectations and use a large cap core strategy to bring a stability and clarity to portfolio amid this ongoing market volatility. Over to you, sir.
Thank you, Akshara, and very good evening to everyone. I am straight away starting to the point, which is how to navigate through these volatile times and what are the best ways to do it. I think let me start with a very simple perspective, which is, India and its attractiveness, which is basically talking about the tailwinds that we can talk about in India. And as you all can see, uh, either on a GDP or a fiscal deficit, whichever way we look at it, India has got an extremely promising story to talk about. Uh, on a GDP, we're still one of the very few economies which can talk about growing at 6.5. And on a fiscal deficit, it is still within the containing limit. All of this has got a strong resultant on the earnings growth. And as you could see, we have kind of doubled our pace on a CAGR growth, which is from an FY18 to FY21. The rate of 6% actually has moved to 13. If I look forward, FY25 onwards till FY28. And that speaks volume in terms of how the tailwinds in India are contributing to the great journey that we are talking about. As much as India is looking promising, there are incidences and there are events that is happening globally, which is also giving a sign that a headwind for someone potentially can become a tailwind for India. And what do I mean by that? If I look at our big daddy, which is in the US, either on a deficit, which is on a fiscal or a current account, US is going through a very, very rough patch. And mirroring that, if I see further on an inflation, which is a third very key contributor and a factor that determines an economy, the inflation in US is shade below than what is the comfort level, which is the 2%. It is at 2.5. So the big daddy in its own health looks pretty fragile, while India on its own looks like pretty promising as it moves further. Now, this is a very critical piece which speaks in terms of how the inflows and outflows or how the FIIs have behaved when it comes to India in last 5 odd years. As you could see, it's been pretty all over, but we have been on a receiving end. And as we talk about FY current year 25, we are already $16 billion negative. And a resultant of that is you could see an impact on the rupee as well. Rupee has been depreciating right from an 84.5, which is where it was in May of 25, and it has almost depreciated to the level of 90 plus, which is the level of today. While it is a concern, it is certainly a concern, but there is also a tailwind opportunity that you could see at least in the minds of FII. One of the key risks, which is the risk on a currency, besides the market anyway, which is a critical risk for any investor to look at least to an extent, the currency risks looks like getting addressed. At 84, 85, I was carrying a risk of 5 to 7% of a depreciation on a currency. But at a 91, 91 and a half, at least we can say that large element of depreciation of a currency seems getting addressed, which also eliminates one of the risks, which is the currency risk. And now institutions can focus on the very critical element of a risk, which is a market risk, and they can base their decisions based on that. So these are the scenarios which have emerged if I see going back and as the economies are emerging today. Now, if this is where the scenarios are, that FIIs had been moving out of the country because they were always of a view that a flight to safety is the way to look at, which is the reason they were deserting emerging economies like India and they were moving to a developed economy like in US. And now with many of those theses seemingly looking reverse, for example, Americans looking like more fragile or a currency risk looking like more addressed, is there a way that we can capitalize on this all volatility through a risk adjusted approach? And the way to look at is a large cap is one of the space where you can find a far and more stability and opportunity to generate alpha. Why? Because they are valued at a very attractively vis-a-vis the non-large, which is small and a mid cap. Now, this is a broadly a way forward approach when it comes to looking at it. Now, large cap has a very unique proposition. The uniqueness of large cap is in the tough times, whenever we have seen the drawdown structure, the element of resilience that a large cap brings in is on a heightened note. Whether if we have just picked a couple of those instances, like a Lehman crisis, 2G scam, or the COVID, and even the cross-border escalation that one could see between Russia and Ukraine, as you would notice, the extreme left, which is the representation of a large cap, the drawdowns have been the least. So a resilience is something which is imbibed in the nature of a large cap, which also gives you a lot of comfort in the volatile times, which is the time of today as we are trading through. Now I focus on a large cap. Now everything we have understood well, but why focus on large cap is the element that everyone is trying to find an answer. Now look at it. If I would go back right from 06 to 25, what we could see that ownership pattern of a large cap is at a 2-decadal low. What used to be 58% on a 20-year average, today we are at a 50%, which is way below and a level of 64 that we had seen in 2006. So ownerships of a large cap within institutions are very, very low. And if I look at a price to book on a valuation perspective, they are right on the median. Now look at it, large caps on a 20-year average, the price to book had been close to 3.3. And today, as we talk, they are at 3.5, which is pretty much on the median. Now, this is the element of large cap, how the world looks like the moment we move out of the universe of large, which is the mid and a small. On the ownership pattern, as you could see the third row of the top chart, against an 20-year average being 18, we are at 23. And against an average of 9 on a small cap, we are at 12. So obviously, and I wouldn't say any surprises, because if I would go back last 4 odd years, money actually got made in the mid and a small only. So obviously, your ownership patterns have to be better. Now, if the ownerships are better, it would come at a price, which is what if you could see the valuations on a mid and a small certainly looks much more stretched than what is an element getting seen for a large cap. They're almost 50% expensive on a valuation, irrespective whether I consider mid or I consider small. Now, if I join the two dots on the ownership and the valuation, I am not surprised if I look at the numbers on the performance of an index. Current year YTD November, the BSE 100, which is the representation of a large cap, the returns have been close to 8, while in a mid and a small, the returns are 3 or negative. This is till November. When we look at this, picture of a December, I'm pretty sure the picture will not look any different. Possibly the outperformances of large cap will be far and more visible. This talks about how the relativity factor, if we draw either on an ownership or the valuation, resulting into an experience, we do see large caps placed extremely well as we look at the times of today. Now, if this is what it is, then how can you play the large cap strategy? Now, one of the way to play a large cap is that why do we not look at a Nifty? Nifty as an index, we should take it. Now, that index is a representation of nothing but a large caps. But when we go a little deeper into it, what we have figured out that within the Nifty 50, it is very well distributed between outperformers and the underperformers. So almost 45 to 55 is a number where you would see outperforming or an underperforming happening, and not a single calendar year right from 016 till 025 where we would have seen a 90 to 95% of the universe being on an outperforming side. So if the world is divided, which is 50-50, so as much as you are seeing the contribution happening, someone is pulling it down as well. And that's where investing in our right businesses is what is making all the difference. If we go a little further and I say, okay, fine, if I'm not looking at a Nifty or an index, can we look at a large cap mutual funds? To us, the closest proximity that one can draw, wherein you aren't getting into a longer tail, is the focused mutual fund, where also you have almost 28 odd stocks. So at the end of the day, whichever way you want to look at it, you are in the strategy where the tails are pretty much visible. So if you have a high conviction, it is also getting distributed on the number of tail or the number of strategies and a longer tail that the mutual funds are owning as a part of the fund. What we have further seen is if we look at a narrower picture or a lesser number of stocks, then we have noticed, and if your convictions are better, well established, there are evidences where convictions actually have given you a better reward. Look at a Nifty 500 value 50 vis-a-vis Nifty 500. There is an outperformance which is clearly visible if I would go back from an 019 to 025. Likewise, on the right hand side of the chart, if you could see the difference between Nifty 50 value 20 and a Nifty 50, again, the value 20 has outperformed Nifty 50. So there is a science, there is an evidence which tells you if your stock pickings are correct, then actually, and if you're able to demonstrate those stock pickings in the right form of a conviction by assigning right weights, then there is a science which says outperformances are potentially possible. So that's another science which is getting visible. But the key is how well are you able to demonstrate that? So ASK has a proprietary approach wherein we are able to dynamically maneuver between the market caps, obviously keeping into account all possible parameters, out of which valuation being one, sentiments being another, and so on and so forth. Basis which we are able to maneuver through, as you could see, as the markets are getting expensive, the element of mid cap starts getting down or getting lower, and those are getting uh, uh, you know substituted with the large caps where they start moving ahead on the ownership pattern in the fund or the representation in the fund. So we have a dynamically managed approach which is helping the investors. Now, if we have understood, and if the general consensus among all of us is that look, large cap is the way forward because of all the tailwind that we just have spoken, and if we are also of a view that to play a large cap is through a concentration approach and not to diversify too much, then one of the ways to play is our own ASK core portfolio, which where CORE represents conviction oriented risk adjusted equity. Risk adjusted to us is the very key point, because in the volatile times when you are, there would be time when you will also go for a risk adjusted or a wealth conservation than a strong wealth creation approach. So I think today is a time, while risk is good, returns are better, but somewhere one has to start looking at return adjusted to risk, which is the core to the wealth management as we go forward. Now, what does this fund do? The fund's approach is very simple. At any point of time, the fund is not going to be investing in more than 15 stocks. Hence, the element of conviction is getting displayed. It will never take more than 70 so when I say all of this, we are also pretty clear that if there is an opportunity to move out of large cap, at least up to 30% of the portfolio can potentially move into non-large also. But today, as we talk, 100% is in a large cap, because as I had mentioned in my previous slide, that every parameter, whether it's a valuation, ownership, and so on and so forth, is subscribing to the fact that margin of safety, risk adjusted return probability, all of it is favoring the large caps, and which is where this portfolio is currently focused at. What you will not see in this portfolio at any point of time, we will be taking more than 15, and at any point of time, we will go less than 70 on the large cap. So it's a very actively managed portfolio. It should be the core to every client as we talk further, and it is agnostic to everything. There is no theme to which this strategy does a hugging. It's a very simple. We have enough elements of inputs which as an outcome would lead to a portfolio creation. We would look at the macro parameters which would help us assess the volatility and how to navigate through those volatility. We have an inputs coming in from the fundamental analysis and the grading of stocks, which eventually would move into looking at picking the top 15 bright ideas in the times of today, and not to take away the very fact that sentiments and technical parameters obviously will have a role to play, which again would help us understand what are the trends and what are the cyclicalities in the stock picking, which is currently ruling the market sentiments. And the combination of that is what is going to be the outcome in the portfolio creation. As I said, as an advisor, it is very simple to as a message. It should be a strategic fit as an element of core allocation for every client's portfolio. It is ideal for those investors who are seeking stability with a very clear, view that I am looking for a potential alphas, and it should complement all the existing allocations. So the best part is it should be a part of every client's portfolio on a core. Portfolio construct is very simple. At any point of time, as I mentioned, not a single stock will take more than 10%. Not a single sector will be more than 25%. BFSI is the only exception where we can go up to 40. It will not have more than 15 stocks, as I said. Large caps will never be below 70%, and it is benchmarked to Nifty 50 TRI and a BSE 100 TRI. Currently, it is on a PMS table, so minimum investment is going to be 50 lakhs. Any top up that you would want to do will be at a 5 lakhs. We have already applied for the sleeve on the AIF side. This moment we get an approval for that, we are going to come back to you. There is no exit load in the portfolio as we talk. Now, this is the portfolio of today. As you could see, and this is the portfolio as of 28th of November end portfolio. There are certain changes which has already got done in the portfolio. When we are out in the month of December, you would start noticing those changes. But The point to note over here is active weight, the extreme right column. I am a firm view, I carry a very, very strong view that if you like something, if you have a conviction on something, it is the best to demonstrate those convictions in the form of active weights. So if you like Bajaj Finserv, which has a weight of say 1% in a BSE 100, and if I like it, look, we have taken an active weight of 7.7. Mahindra and Mahindra, good auto company, having an element into agri businesses as well, has an active weight of 7.4. Kotak Mahindra, SBI, BEL, Ultratech, and the name can go on. The way to look at it is we have added decent active weight across the strategies where we see our confidences in. Now let's go back. If you're talking about a situation wherein we have a view that risk on trade, and here I mean by risk on is that the monies can potentially move out of developed economy to developing economy. If those kind of reverse move or trade or a risk on trade happens, and if India among the emerging markets become one of the key beneficiaries, then the initial flows are going to be coming in these large caps only. And if you are already settled in that space, then as an investor, you would be one of the key beneficiaries of those initial flows. So I think that's a very, very key element as we talk today, because that is what is defining how can we manage volatility in this time. Because one thing is pretty sure, whichever way look at it, India is not expensive. We would need to find our ways to navigate through these times, because when you are expensive, you are obviously vulnerable to heightened element of volatility. Now, in order to contain that, somewhere you have to hunt for risk-adjusted, portfolios where element of risk is not overboarded, and the core portfolio in every probability has taken care of a lot of it by looking at the large caps where, the volatility element is relatively low. There is always a risk. There's nothing called a strategy without a risk. It does have a concentration risk, because at the end of the day, we are talking about 15 stocks portfolio. The as you could see, the allocations have gone as high as 8.5 to 9% or more than that. So there is a concentration risk for all possible reasons. There could be a delayed mean reversion. While we all can think about that, risk on flight to safety approach can take a reverse view, but nobody knows when. We all can work on a probability. Well, probability looks pretty high, but there could be a delayed mean reversion as well. Uh, on a time suitability, yes, one would need to have patience to see the wealth creation happening, and hence you should give a reasonably good time, 4 to 5 years, for the portfolio to give you the desired results. And any changes, again, that probability always stays. When we talk or when we create a view, it is on what is optically visible to us or what it is the reality in the times of today. But we are in a dynamic state of affair. The macros, regulatory risk always stays, and that can be a key factor as we go further. Our philosophies are very, very simple. I think this is something which is a time, if we have been following this for like decades and decades. We call it FOCUS, which is not to be a blind to any kind of fundamentals. That is a core to picking any stock, any ideas. We would need to see what is the size of the opportunity, what element, to what extent can that be scalable. We will have to see in what business cycle or what market cycle that strategy or that company is in. Does this company have something which is a moat, which is either on a technology or a brand or a distribution, some kind of moat, something which it has, which differentiates it from many other, and margin of safety is prime. If you would want to onboard anything in the portfolio, that would need to come at a right price. Not at any price, and every price is a price for you to get it in. So this is something which is our core as a philosophy. If we further go ahead, keeping that philosophy in mind, our framework, we call it MFS, which is but nothing but a macroeconomic parameters, which is to have a view on asset classes, market caps, sectors, themes, which is more like a top down. We would go and build a view first on that. How do we see? And then further down, come down to the fundamentals, which is absolutely data driven outlook, where we have where we would actually work on 750 odd companies, out of which 450 to 475 are in the active research as we talk today, and the very fact that all those fundamentals needs to be governed by all the seven aspect that you could see, whether it's industry structure, governance, growth, balance sheet, profitability, advantages, position, and evaluation. I think that comes right embedded when you talk about a framework. And as I had mentioned before, your sentiment, technical factors have a role to play when you are looking at making a framework. The investment team, as you could see, George is the man who is leading the investment strategy. He's a CIO and a CEO for the company. We have got two deputy CIOs, as you could see, Sandeep and Amit. Few more are joining in, as you could see, 2 plus 2. And as we talk, we have got a 10-member research analyst team led by Saurabh Patwa, who's head of research, having joined in from HDFC AMC. So this is the way I see, which is how can we navigate through the times of today, which is looking very volatile. I would rather say, rather than me having a monologue, why should we not look at more of a dialogue kind of a concept? So Akshara, I'm very happy to take questions if you have any.
Of course, sir. Thank you. And we had a bit long PPT as well, more starting from India, and then you spoke about the stat course strategy, and then about ASK as well. So
Yeah,
we started off with India. So I think I need to ask this one question. Of course, India is all positive from our side, but when you
yeah,
go to put India into the world map now, and
yeah,
MSCI Index, Emerging Markets Index, ma'am, India has
yeah,
not is it either been flat or has underperformed actually.
yeah,
In the
yeah,
last 2 years, 2022 and 2024, it has overperformed the benchmark.
yeah.
So how this is how the markets have been for 2025 for India. So
See, we
how do
will need to understand, Akshara, that when we compare also the emerging market, also need to understand that what had driven the emerging markets. So
you
one is the AI play. The AI play had been one of the key dominating factor, and India isn't part of that.
yes.
So I think that obviously has kept us on a back foot. When a lot of monies were chasing AIs, we weren't there. Uh, Not to forget the very fact that we aren't cheap as well. As I said, that we are an expensive market. So people would do the way we do asset allocations, institutions do their own geographical allocation, where do they see, valuation supporting the case. Yep, I think we have also slowed down on our growth path, if I have to look at it. And not to take away the very fact that apprehensions stay, when you have someone talking about a tariff war, every
Mm.
second day someone coming and making the statement which aren't good or encouraging, then it does spook people. At the end of the day, we all are human beings. So we would want to see this uncertainty go away. For example, tomorrow, if all these trade deals shapes up and becomes a reality, and uncertainty goes away, because what market doesn't like is the uncertain times. So when this uncertainty go away, then all the headwinds that we are talking about can
Mm.
potentially become a tailwind. So look at the AI piece. Now, the globally, this has become a concern to many people now. It has got relatively overplayed than what it could have fundamentally got justified. So I think all the headwinds to us, which were a potential headwind till now, are actually becoming a tailwind. So now when the reverse flow would happen, and people will look for other kind of fundamentals, possibly we are there to take advantages of that.
Okay, so this advantages we are looking out for will be for the next, of course, 2026.
Yeah, absolutely. So we are making the forward-looking statement. So
Yeah,
absolutely.
so for that, for if you're going to see give an outlook in like one or two liners for 2026 for the investors or advisors who are on the call, so what would that be?
So I can see, I will not be surprised, and that's what I started mentioning in the call as well through my couple of the slides. I wouldn't be surprised if we can see a 26 being a very different year than about 25 is. 25, we lost close to what, $16 billion of money?
Yeah.
26 could be the year where we could see the money flow being positive. Now, let me make one statement, which is like a very, which is quite an eye opening to us. When we look at listed space losing the flows, $16 billion, you would also need to look at the unlisted side. Where we are losing money on the listed, the same FI is committing the money on the unlisted also. So net net, we aren't losing. We are losing because we could see the market losing the money on the listed side, which is visible to us. If you see the unlisted flows of FIs, I think the money is almost the equal amount of money going there. Why was that happening? Because the arbitrage opportunity was very high on the unlisted when it comes to comparing the listed side. Now, in last couple of years, even that arbitrage also has gone. Unlisted is no more cheap now anymore. We have just seen the couple of IPO which have come in. They have almost got listed at 50% to the what gray market prices were. So that should give you a sense that that space is no more as cheap as it used to be a couple of years back. So if I now join the dots and could see that the risk on trade can happen, the monies can be further take a route to the listed side, then yes, FY26 certainly is going to be very encouraging year for the all of us.
Well, so we are, starting with a very positive note. And of course, when you talk about, large cap core strategy as such,
Yeah,
so that strategy is very concentrated with only having 15 stocks, I suppose.
yeah,
And downside, this is also relatively new strategy that in the market. So it has not seen multiple market cycles either. Because this
yeah.
means 5, 6 months, if I'm not wrong, July was its inception.
True. True.
So it has never seen a bigger drawdown.
Yeah.
So if you want to talk, of course, it is risk adjusted strategy. But if you want
Yeah.
to emphasize on what kind of expected drawdown from investor or advisor could have from this particular strategy would be.
So actually, I think I if you would have seen the table that I had shown in the beginning, where in the top end of the table talks about the ownership pattern being less than 2 decadal low. 2 decade being at a 58% on a large cap, we are at a 50 today. Anyway, the element of drawdown is pretty much experienced. Where do you see a drawdown happening is where you have made money. In large
No.
caps, if you would go back in the in the quality stocks, last 4 to 5 years, the returns has been either negative to a flat. There isn't much money which has got made. So, and that is pretty much evident even if you look at the price to book on a valuation side. It is exactly at a median, when mid and a small is quoting at a 50% premium to the 20-year average. Large caps exactly at a median, which tells you that it is neither over-owned nor it is expensive. And the resultant of that, if you could see YTD, the current year, FY25, that space is the only space where the returns are in the to extent of 8.5%, while rest of the universe is flat to negative. I'm talking mid to large, mid to small. Why? Because ownerships were there, the monies got made over there. To me, this is a good time where you could see monies can potentially shift from a mid and a small to a large when it comes to domestic. And when it comes to the institutional money coming from overseas, you would anyway see large cap being one of the key recipient, because that's something which is the natural way of looking at it. So by all means, a large is going to be one of the big beneficiaries. Your question should also be, what is it where you see the fear factor being heightened? My sense is mid and a small space is all set to either see a price correction or a time correction. The
Okay.
quality mid caps are going to see a time correction because they are way ahead of the fundamentals anyway. Now the companies would need to deliver on what those expectations got set. So hence the core having an opportunity to also move into mid and a small at the right time up to 30%. Today looking at being more opportune in a large cap is currently in the large cap to up to the 100%. And 15% is very swift. 15 stock is very simple. We might call it a concentration. But if you feel opportunity is the best to tame, then you would need to showcase that by adding active weights and not to maintain a long tail, which is the reason it makes a lot of sense at today's time.
Okay, so I'll just take a few, questions falling onto the call as well. Of course, Patel, I would take the questions on the performance as well. The point is that it's a relatively new strategy. So stating the performance would not make much sense because we're looking for longer term wealth creation. But even though you've asked it, so with respect to that, Patel has a question called share the performance details compared to his benchmark. If you want to take it, sir, since inception, if you could give some returns.
We have been right on the benchmark. We were right on the benchmark as we talked today since inception. The point is, as you rightly said, Akshara, it is on very early days for the fund. And second is, it is also the time when this space hasn't seen the buoyancy. So we are trading through a patch wherein we haven't seen the buoyancy, but in terms of returns delivery, we are right on the benchmark when it as we talk now. But my point is the scenarios are getting built now. I am building the case for a large cap and containing volatility now. So maybe next time, Akshara, when we will meet again, maybe out 2 quarters down the line, I think this question I'll be much better prepared to answer because then I'll have a little bit of a history to showcase.
Makes sense, sir. So one more question from the same person, but if you want to answer that. So if you consider Geo in BFSI, combined exposure of Bajaj, SBI, Kotak, HDFC and Geo is more than 40% for the screen that you've showed before. So like this is what you have put as a question. So if you want to
It's
answer.
very simple. It's very simple. If I look at a BFSI as a segment today, uh, that index itself is 42% representation on the index. So not that we are too much away on the allocation piece. The way I have allocated the assets is something that you and me can always discuss, that we have kept it within the four stocks, all of this. While if I look at a BFSI, it has got much more. Number of stocks are far and more. Which is what we have said. One of the feature of the fund that banking is the only side where we can go up to 40%. And hence we have taken 40 as a number. While rest of the sectors will have a cap of 25. Now these are active caps. So today, even if I wish, I can't go beyond 40 on a banking. Why? Because that's my active cap. Passive, we can go. For example, these four stocks does very well, and my 40 can become 47, 48, and we still feel there is enough room for it to move further. We wouldn't change anything. But passive, if I have to look at it, or sorry, active, if I have to look at it, 40 is my number. I can't go beyond that. So that's the reason you could see a number of 40.
Got it, sir. So when we're mentioning now that the strategy was benchmark hugging, so I'm not taking this as an example now, but let me keep it as a very broad question. Over the last year, let's take 2025, most of the PMS funds have not delivered bigger alpha. But Nifty, if you ask me, Nifty has it given alpha? Yes, of course. Nifty is seeing new time highs every day, but funds have not. Do you feel that alpha generating alpha has been narrowed in this current market situation?
Akira, you have asked a very pertinent question which is currently worrying me. I can promise you we are in a time when the life for our friends on the call is not going to be easy. And this is not first time that we are seeing something like this. It has happened in the past as well when we see Nifty making new time highs and the portfolios aren't.
Yeah.
It's very simple. Simplicity is, as I said, if valuation catch up is the way to look further, and valuations are making more sense on the large cap, and your portfolios are in a non-large side, what is happening? Index is moving up. Why? Because the large caps are contributing to the index movement. Your monies are lying in a mid and a small. It is not correcting. I just said to you, it is not correcting because it's a quality portfolio. But it can go through a time correction. And that is painful. So what you will be noticing that index is making all-time high, but portfolio is neither correcting nor moving up. It is static. It is pretty much range bound. Why? Because now it is experiencing a time correction. Is the point that I was making. This is the time for one not to fall in the trap where we all have fallen multiple times in the past. We are getting into the same arena where valuations catch up is going to be the order of tomorrow. And if you would want to be part of it, rather than trying and explain the clients why the portfolios are not moving, it is better to align the portfolio to the core which is where we see money making potentially can happen.
Okay. So when you say it's a very concentration oriented portfolio, what about the portfolio churn? How does that work here?
See, I'll tell you, portfolio churn is a function of multiple things. Number one is that your entire thesis on which you have onboarded a strategy gets defeated. Or it could be something has moved too fast too soon. If none of these two factors, because large cap is not something which is going to double over next 2 months, you would notice the portfolio churn would be relatively low in this portfolio. It would be something that if we have taken a view that it is high conviction ideas, we have built a view on something where we see the company on a business model delivering, until and unless that gets defeated or that has got caught too fast too soon, you will see a very very stable portfolio as we look forward.
Okay. So when you say that, because you are from sales and distribution part of it, so if I could ask this question to you at this current juncture of the market, is it easier to convince a distributor to sell your product, or is it easier to convince the investor to buy the product?
I'll tell you, it is convincing, and I do why. At the end of the day, Akshara, the color of happiness is green. Darker the shade, better it is. Ultimately, who are we serving? At the end of the day, our end use statement is to serve the clients.
Yes.
Distributors are my partners through whom I am reaching out to the end user. I have no intention to start my own B2C platform. Now, if that is the case, both of our endeavor, whether it is me or our friends on the call, is to see the client creates money. They create wealth. Now, clients have not asked us, give me something which is different. He has simply said, look, I have given you 100 rupees to make money. Please make 15, 12 to 15%. I'm a happy man. Akshara, this is a time when simplicity is the mantra to success. Every time we do not need to look different. At times, being simple is also being different. We are in an arena where, whether we like it or not, certain aspect like a volatility is going to be our friend going forward. And if we would need to contain this volatility, we will have to be simple. And the definition of simplicity is to stay in the large cap. Let we all do that, whether it is to convince a client or a distributor. But that's the way it is.
Okay. So, of course, it was quite partially answered, though. But the next would be again from investor perspective. Of course, across India, where do you find the maturity for investor comes in a huge number? Like, is it from the south or is it from the north? And how do you see the education evolving in investors, think about the markets?
I think India is one beautiful country where wealth is well diversified. I can't pick a pocket to say, where the monies are. Yep, you can ask me where the gold pots are. I would say South has got a huge gold in it because of natural fascination among the South Indians for a gold. But when it comes to wealth, I can tell you, Akshara, it's very well diversified, well distributed because people have really created wealth thanks to our partners on the call who have been instrumental in many of their clients creating wealth. That is not too big a thing. What is important, and that's the second part of the question that you asked, which is very critical. The awareness among the people or the investors are far better than what it used to be in the times of past.
Okay.
So, at least when we go and connect, let we be very clear in our mind on two, three things. Number one, we are not the only one who is engaging with the client. Client has got multiple advisors. So you need to be smart, you need to be honest, you need to be transparent. Number one. Number two, you need to look at client more as an inclusive. What do I mean by inclusion? Inclusion would mean educate the client also. While knows it, but let him also be aware of what is he getting into when he is giving the money to you. That is very important. Gone are the days when we can simply send a form and tell the client, sir, sign it, and client will send it to you, and then you have invested the money. No, don't do that. Please make him inclusive, make him understand, educate him while he is anyway being educated. Why? Because technologically in the digital world, he has access to multiple modes of information coming into him. You are not the only source. But when you also complement to that, it adds to the trust, which is the key to our business. So I would say, yes, clients are educated, but don't shy away sharing as much information on the product as you could, and never ever try and hold back the element of risk what the products are associated with. If you have taken these two aspects clearly well documented and described, let me tell you, client do understand at the end of the day, it is equity, and equity, while it can create returns, it can also have an element of drawdowns.
So it's like an advice saying that just being transparent before the client brings in the money to you. So
Absolutely, absolutely.
so that was a good advice for the people who have joined us today. So other questions are on the portfolio returns and the commission and the profit sharing fees that can be taken off air.
We will
Uh, anything else that you won't tell us before we could close, because this is the last webinar for this calendar year. So next webinar for the month of January. So if there's anything as a statement that you want to give us and also the viewers.
So Akshara, I can only say to you that uh, the only thing which is constant in the world of wealth creation is the change. And when I say change, I mean change in approach. Last 4 years has been a great time wherein you had created enough wealth for your clients, being in the mid, small, undiscovered, unknown, so on and so forth, hidden jewels, and we have given a multiple names to all of those things, and we had created wealth. I would take a step further to say, wherever ROE arguments were well established, last 4 years the wealth has not got created. Look at all Hindustan Unilever, HDFC, most of the large banks, Maruti, where it was established business, earnings predictabilities were known to everybody, ROCE and ROEs were well established, but market wore a different lens. And all of us who kind of embraced that element of market's behavior has ended up creating a lot of wealth for the client. So all your sectors like a defense, PSUs, railways, commodities, all have created enough wealth. But market also has a habit of looking at a decadal shifts. And when they have a habit of looking decadal shift, it is very important that as an advisor, when we are a part of the market, we stay ahead of the curve. And today, the broader point that I made, which is to, for a second, wear a different lens than what you were wearing till now, and start considering large cap also as a strong proposition to wealth creation, even if at the back of your mind you feel it's a very boring subject and it has got nothing to do with what do you talk about Reliance here. We all know Reliance what it is. What are talking about HDFC? We know what it is. My friend, there are times when to be boring is also to be intelligent. So this is a time when we would need to transit and consider a new emergence or a new approach to a wealth creation, which is where we should look at large caps, which has a strong element of margin of safety on a wealth creation. Last but not the least, if I have to say, money which is in paper is not yours. Your money is the one which you have already capitalized, which is where you have booked and got it in the bank. There is no harm in booking profits and then taking a further view how to take it forward. My take is be ahead of curve if you want not to be part of the herd. And that's the only mantra I would want to leave it with you all to think through. I have a strong, intelligent set of people on the call. They understand what I'm talking to. But the way to act, if you feel in the most efficient way, I would say our ASK core portfolio is just there to take advantage of the opportunity which is available.
Thank you, sir. I think it was an indirect, sales which I could hear that. Though, because I asked some kind of an advice, and again you correlated that with an ASK core strategy. Brilliant. So I think we need to learn a lot of things from you in such a way that. So thank you for that. And of course, markets are such a way that obviously our portfolios are giving more allocation to large caps because mid and small caps have always been in red. So with that, I think that's a closing note, and also for the investors or the distributors, IFAs who have joined us today. Thank you for your patience, and of course, it's a long week off because Christmas is fast approaching, and then the New Year. I would like to wish everyone Merry Christmas and a advance Happy New Year.
Yeah, so too from our side, from an ASK family, wishing each one of you a Merry Christmas and a very Happy New Year. And the May New Year brings in hell amount of prosperity both for you and your clients. Thank you.
Thank you. Thank you. Thank you.